Hey everybody, it's Bob and Phil with another edition of the Trade Genius podcast. Just want to give you guys a warning ahead of time. If you anybody who is sensitive, we have very, very disturbing content to share with you. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. So Phil, I'm a guy who shocks easily, and we've been in a doom, boom, zoom type of podcast here for the last couple months, but this one got me. And this is really, really scary because I think they're full steam ahead on this approach. And I'm going to throw it to you because you found it. And if you can explain it to everybody, you need to pay attention, folks. Very important.
Yeah, and we're not talking about the stock market chart, which is also really, really red today either. That's a different story. No, this is about our money supply growth. And obviously, as you guys know, and as we've shown you with the liquidity charts numerous times, there's just a lot of excess liquidity in the system. And because of that, because of what the central banks have done, they have to back that out now because we're seeing, big inflation numbers coming in, and it's starting to look like it's becoming entrenched, which the Fed's really, really afraid of. And they've been banging on the drums about, getting it down, and they're not going to waver on 2%. So with that being said, here's a chart of the money supply growth, and you can see it's negative 2%. The problem with this, there's a couple problems. One is historically, when you get these negative prints, look what happens. You got the 1870s depression, the panic of 1893, 1921 depression, the Great Depression. Okay, these are significant downturns in the economy, and these aren't like your quick, COVID was like a 1 month recession crash, right? And this isn't that. This is months and months and months, and more like a year or two is what this is implying. The problem with the reading that we have here, not only is it -2, it's probably going a lot lower, which is scary because the Great Depression, it's like the lower you go in this money supply growth, the worse the recession or possibly depression becomes. And I wanted to flip to this other chart. So this is the money supply. So that red vertical line was when everybody panicked and we had COVID and they just said, give everybody money, print. Okay, we went from, we already had a pretty good growth in the money supply. So, Fed was accommodating this whole time. This is why the money supply was growing. COVID comes along and they panic and they just printed trillions of dollars. And so it went parabolic, right? That jump there is more than we've seen in most of the years prior to that, all combined into one squirt. Okay, so now we got hyperinflation. So we've got a ton of money to come out of the system here, which is going to drive this back down further. And all of that is very bearish for the economy, okay? And it's very bearish in that the stock market probably shouldn't be where it is because of what's happened here, because it was so aggressive in the money printing, it forced everything higher. And that even includes Bitcoin, that squirt really fast to 60K, right? Probably wouldn't have happened in the way that it did without the Fed doing what they did. So, we got a long ways to go is what we're saying here. And this graph is pretty significant. And, I think you got to really stare at this thing because these are significant dates in our financial history as a country. And what we're trying to tell you is this is probably going to get way worse before it gets better. It will get better, but don't be lazy here and think, COVID, we crashed and then we bounced. No, this is totally different because the Fed's on a mission now to get this inflation back under control, because at the end of the day, they're going to be looked upon as the cause of that inflation because of the way they handled our monetary policy. So that was something that I thought was very apropos here. And today and what we've seen in the last couple of weeks with the market pulling back from 4,200, in my view, is a longer road down that most people are discounting because they think the Fed's going to come back and start cutting or pausing and cutting. And I just don't think that's on the table here. And I think that's what they've been trying to tell us without freaking the market out. But the market's not getting the memo. So they come back like at the hearing here, at Congress hearing, that Powell was at, and he just basically laying down the hammer again like he did back in November at Jackson Hole. So Bob, that's, I think it's just a very clear, like neon red lights. Don't get invested long in this market here in anything, real estate, all this other stuff. As much as I'd like to see Bitcoin go up too, I can't sit here and tell you that that's going to be a good, or this is a good safe spot for it, because there's just too much downside risk here.
Yeah, and look, but there are ways where you can protect yourself. So, not to plug our service, but I'll plug our service is that, we're in TLT, we're in SARC, we're in BITI. So that protects you on the bond side, protects you on the Bitcoin side, it protects you on the NASDAQ side. So there are opportunities here to protect yourself in this environment where you don't have to just go all to cash, even though you can put your cash now in 5% bonds, right now for 90 days, 6 months. Because look, Phil's right. There's momentum to the upside, and there's momentum to the downside. And the problem is the wrong people are tapped out on credit. And the people that don't need credit are going to be the people that are likely to keep their jobs. And so it's a situation where you just can't keep force feeding the system without force feeding inflation. They can't Goldilocks this anymore. So we're going to have to take our medicine. And, from 2009 to 2023 is a long time to have an economic retrenchment. We should already had one, halfway between that point of view, 2015, 2016. There should have been some sort of pullback just as a natural course of economics, but they just kept doubling down on the money supply. Well, we're at a point now where you can't absorb it anymore. And it's just not the United States, Phil. Look at China. They have cities in China now that are going to go bankrupt. When they go bankrupt, cities' civil servants lose their jobs.
Right.
So, everybody talks about China being the rescue. China's going to be part of the problem in this situation. And Germany and Japan and Korea, these are companies that are mercantilist countries that rely on exporting. Well, the United States is pulling back in. We should talk about that, what Powell's really doing here, Phil, sometime, in terms of he's not just fighting inflation, he's fighting for the survival of the United States. And we're going to force everybody else into depression before we go into one. And it's worth noting that he can't return and flip on what he's doing, or all is lost for the United States. So it's just going to be a situation where people are going to have to really eat some pain here in order for us to fix this thing longer term. And there's no way out of this. And that's why we've been so strident for so long on this, because we've seen this coming, and I'm old enough to see the 87 crash, to see the 98 crash, to see the 2000 crash, to see the 2008 crash, the flash crash, the 2021 crash, and now this one. This is the worst of them all, Phil, because the extremes are to such a level where you just can't flippantly solve it. And either way, now you have a choice. You hyperinflate or you crash. And I think they're going to protect the dollar this time.
Right. Yeah. And I think they're going to, I agree with you. I think they're going to protect the dollar. We've been in a basically a cycle where, they've avoided having a strong dollar, in my opinion. It was bad for the world, and the world economy. But in this situation, I totally agree with you. I think it's a defensive posture now. I think it's a geopolitical posture. They're going to weaponize the dollar, which means they're going to have no problem with the dollar going up. And I think part of that too is making people see, if the dollar gets really strong, weaker countries will try to peg to that. And you get into a situation where they kind of forces them to share in our pain, which is our multi-trillion-dollar debt. And that's how you can kind of keep the party going, even though they're going to have to get the debt under control. I mean, let's face it, right? The numbers that came out today, the GDP was going to be over, I don't know what it was, 109% of our GDP in the next 10 years. I mean, come on, right? It's insane. So I think they're going to try to weaponize the dollar to try to keep the party going on, which is a lot different than what was happening prior to this, right? With trade and everything's honky dory. But now with inflation and this and that, and the debt being an issue, they're going to go after the dollar and make that strong. And that's something that most market participants, traders, whatever, the younger generation hasn't seen a geopolitical environment where that's the goal now, is having the dollar being very, very strong against all these other currencies. And that's why you see like the euro going back to parity and things like, I mean, remember it was like $1.30,
Yeah.
It's probably going to go under parity and stay there for a while. So we're in different times now. And I think with just I think they overreacted in COVID on a number of things. It's gotten us to the situation now. They do not want the inflation monster getting out of control. And currently it is a little bit. And so they're throwing everything at it. And I think the market's finally getting the memo here, Bob.
Yeah, look, and I think this dragon bear thing, I think what it is, they shot their rifle off too far away from the troops. And the Federal Reserve saw this and said, hey, Europe's trying to screw us and China's trying to screw us, and we got to maintain supremacy of the dollar. And if that means there's going to be pain at home, so be it. And I think that's what's going to happen here. And this is not a quick fix, Phil. This is like you said. I think you're saying end of 24. I absolutely can see that.
Yeah, it seemed a little ridiculous when we started looking at it, but I'm a firm believer that the bond market's always right. And I remember showing you, like, Bob, look at the yield curve inversion and look what happened. It's like it's 100 weeks of pain, 2 years basically. And at the time, it just seemed like these markets don't seem to do that anymore. But the Fed's basically saying we're not joking. It's going to 2% if it takes 2 years, right? The only caveat I'd put on that is, if things start to break and you get some sort of black swan like in '08 or, COVID, something out of left field happens, the Fed's going to accommodate in some way in an emergency fashion. Maybe they'll say it'll be very limited, but just to keep the markets from, keeping the ATMs working, I guess you could say. So I think there's the possibility of that. But I don't know if they're going to be so quick as to just broadly say, well, we're going to reinitiate QE. Things would have to get pretty dire at this point for that to happen. I think they're okay with the economy just going down for a bit. And then two, Bob, I thought maybe we'd look at the chart real quick today since there was so much carnage.
Yeah, and you know what, guys, while he's getting that ready, little humble brag on our part too, because this is we've been waiting for this and we've been positioned for this. And last week the Fed threw another curveball at people who are being practical about the markets, and that got totally eviscerated today. Do you want to show them that?
Yeah. So, I mean, part of the Fed liquidity package that we'll be releasing is how, risk on, risk off signals. And it's more of a general, like, okay, hey, we got a risk off environment. We don't really want to be looking for longs until we see risk on again. And where we really get concerned about it is when the fair value is over its skis in this red area. Okay. And so when we get that condition and then we see risk off come on, what that tells us is wait for a broader rotation of fair value to get back down into the green territory. So if you look at, like, as we've come down from the highs, every time we get risk off and fair values elevated, we get a lot of downside. And sometimes the liquidity will come in and you'll get a little risk on, but quickly that gets erased and it goes risk off again. So we watch between those broad signals, which is telling us that liquidity is either coming in or going out. If liquidity is going out, like that blue area, forget about it. Like, price is eventually going to snap back down to it. What gets tricky is like what we just went through and everyone's telling us we were too bearish. It's not happening. Bear market's over. And we were saying, well, look at August. I mean, August stayed elevated for a while and started to pull back in. In August, we basically had the warning bells here, and then we finally had a risk off confirmation here. This time around, we had a risk off confirmation here. We had to endure a few days of putzing around at this level, but we knew because fair value was up here and it's still elevated, but that it should start a counter rotation and get us back down. And that's why we're very cautious here. And we were saying, be careful up here because we got a long way to rotate back down. This is telling us we're about 300 points over value. And that's if they don't drop liquidity, that could actually go a lot lower. So, okay, where are we going? Well, you know what this market likes to do in a bear market? Take out swing lows. That's 37.63 there on the S&P 500. The next one down, 36.96. And it gets, it's just going to go after all of these swing lows. October low, you think that's going to survive? Probably not if this thing resets back down to zero, because it's just going to be too close in proximity. And the 200 weekly moving average, which I don't have on here, but that's probably going to be the next big downside target. And if we do get to this low, that 200 weekly breaks. And in a bear market, when your 200 weekly breaks, see you later. Because that's when the real ugly part of the bear market happens. So you want to stay hedged. You want to keep a short on. Come in the room if you don't know how to do that. We'll show you how to do it. You can even start off with micro contracts on the futures. It doesn't take a lot of money, but you can hedge yourself, hedge your net worth to a degree. And then when the all clear, which would probably, Bob, for me, I want to see the all clear on the weekly. This is what the weekly looks like. Risk off. See that? Nothing says get generationally long here for a rotation. Even through all this, risk off. One day we're going to get a risk on this weekly chart and we'll be good to go. Then you can take those hedges off and we start building for the future. But until we see that, it's not going to happen. So we'd love to see you guys in the room because we can get through this and you don't have to lose money. And you can certainly make money actually on the way down too. So
yeah, and one thing too, Phil, I want you to talk about it too, because I think you're really, really good at that. Phil and I have really different skill sets, in terms of, trading, in terms of how we approach things. And one thing that Phil does extremely well, and he's able to communicate it well, is that I'm more hit and run. Phil's more of I'm more of a rabbit. Phil's more of a turtle, kind of approach. So Phil takes smaller size, and he's infinitely patient, and he gives himself enough room to run. And I'll let you speak to that. And the thing is, what these liquidity charts allow you to do is like, look, when we get these risk off charts, okay, you can go out a month or 6 weeks, take smaller size, and don't panic, and let them look. It always will go back to fair value. It's a simple physics, and you can just wait it out. If you do that in the option market, but if you do it in the futures market, and I'm stealing your thunder, Phil, so kind of give your thoughts on that stuff, because I think you give an excellent explanation to the room today. It's very calming to people, because a lot of people, especially new traders, they see a risk off, or you hear something like today, market went down, people push all their chips in, they call shorting into the hole, and the market does a quick bounce up and they wipe you out like they did last week to people, and then continues on with the trend. So you want to speak about it a little bit? I think it was excellent what you talked about today.
Right. So let's just say we see this chart, we get the risk off on the weekly, right? And we know the market's faltering, and we know the Fed's tightening back here. So okay, risk off. So I'm going to reposition myself. I'm going to go to cash, or I'm going to take out hedges. If I don't want to trigger, let's say I don't want to trigger any tax things, I'll get some inverse ETFs, go buy those, because they go up as the market goes down, or short futures or something, whatever the case is, or long-term options. But you're essentially putting a hedge on here, and you're going to keep it. Now you can take some of it off this is the thing, right? You want to stay hedged through this environment until you get the risk on, but it doesn't mean you can't take advantage of the bounces. And even if you want to take like the rabbit approach, like Bob, I mean, these are like, when we get to these overdone levels, and we're just looking at our fair value package here. There's way more that we can look at to really pinpoint things, and stuff we look at intraday that we're not even getting into. But this is just like bare minimum, easy to do just with this chart. But you can go into these areas where we get overdone to the downside, and then what happens? You get these nice couple 3-week rotations, right? Come back down into green again, same thing, multi-week rotation. So it's like you want to be hedged, but this thing also lets you know when you can take some of that hedge off. So you don't even, if you're scared about going long because you want to stay with the risk off cycle, that's fine. But you can take those hedges off, be more neutral, or not hedged, and it goes back up. Then when this thing gets overdone to the upside again, you get re-hedged again, right? So it's very clear here on the cycles. I mean, Forrest Gump could trade this. And the same thing here, got back up to the highs. You just, that's telling you, okay, hedge is back on. And the hard part probably for all this would be just when we go through these periods where there's a couple of weeks in between and the market still trying to go up and everyone's questioning like it's over. No, because this thing's telling you, nuh-uh, not in this environment. And so that's how you do it. You keep a hedge on. This thing helps you pinpoint whether to take those off or re-add them. And we're just getting into a situation where you should have re-added them in the last couple of weeks, like we were warning, and now we're rolling over. So that's a weekly view. Like I said, we can get more granular into daily and stuff like that. This will tell you, like, yesterday, stay short. Even though we had the bump today in the jobs numbers, we knew that the technicals were saying stay short. And sure enough, I mean, boy, did we get paid today on that. So
absolutely, size matters in trading.
It does.
Sure.
It does.
Well, hey, Phil, thanks. That was awesome explanation, guys. And tomorrow's gonna be a really interesting day. We've seen this before, where this could be a gap and go down day, or they may tease us like they did today, and they pop it just to clear out some of the more exuberant and more leveraged players, and then roll again. But Fridays tend to be, especially news day Fridays, a trend gets established in the first hour, and it typically maintains that trend for the day. So either they're going to try to flip this thing back higher, which we think is less likely, or we're going to roll down and try to continue to correct this market back to sanity. And then you're not going to get a chance. So once the market sets that trend, it's going to trend up or it's going to trend down in most Fridays. So just beware of that. Thanks for listening. Hit notification, hit like, watch our shows, share it, tell your friends. Look, we want everybody to come out of this thing alive. The nice thing about trading is I can win and you can win. Yep. So we're happy to share. And we want you guys to win, and we want you to be also aware of what's going on here, because you don't get to see this type of information on CNBC and things like that nature, because it doesn't go well with sound bites here. Right. We're trying to give you a little bit of inside baseball here to help you understand this market is not mysterious. It's opaque, and you have to just be able to find out what really moves the market and take advantage of it. Thanks for listening, guys. Have a great day.
See you later.
Trade Genius.